Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking some time out of your busy day and spend it with us. We have a great show for you today and another great guest. We have Dr. Jack Mintz. He is a senior fellow at the C.D. Howe Institute and a fellow at several other organizations. He's influenced structure of tax policy, influenced the structure at the provincial level, the federal level, international tax systems. And he's consulted with the IMF, the Organization for Economic and Cooperation and Development, OECD. He's done a lot of advising with respect to tax reform, tax systems. I had the pleasure of catching up with Jack this past week and talking to him about Canadian taxes and his most recent article about big bang tax reform here in Canada. A fantastic interview. And we're going to bring you this interview right off the top of our show today. But let's also put up a list of all the other topics we have for everyone this afternoon. There you have it. Big Bang Tax Reform, an interview with Dr. Jack Mintz, renowned tax expert. Then we go into our top 3 things to consider over the next 10 business days. Very popular segment of our show. This talks about 3 things that I think individuals should be considering or at least understanding before they make their investment decisions. The markets have rebounded in the month of April, the last 2 weeks. Should we be surprised? I wasn't. Are all of you surprised? We'll talk about that. Take futures markets with a grain of salt. Every morning, it seems like, especially Monday morning, come off a weekend, we wake up in the morning, and before the market opens at 9:30 here in Toronto and in New York, we get the futures market, and that gives us an indication as to what's going on. Is the market going to open up down? Is it going to open up higher? And I wanted to talk to you about the futures market and what it actually means, because I think a lot of people can be confused and can cause maybe even the odd investor to make an emotional decision that they shouldn't be making. Mixed economic signals, jobs and inflation. We've been getting a lot of mixed signals coming out of the Federal Reserve in the US, Bank of Canada, the data that has been really mixed. We're not sure exactly what to think. Will the Fed cut rates? Many believe that they will later this year, at least once. Will the Bank of Canada cut rates? Not so sure. They haven't really hinted either way. I know that the market was pricing in the Fed to raise rates actually at some point this year, but most people believe that that was not going to happen, and I'm included in that group. Don't think that they're going to be raising interest rates anytime soon. So mixed economic signals, jobs, and inflation. Quick hits, 3 things that I've seen in the news over the last few weeks that I wanted to comment on. And last but definitely not least, your questions. As always, if you have any questions during the course of the show, please put them in the chat box. Individuals will be by to pick up those questions and give them to me, and hopefully I can answer 1 or 2 of them before the end of the show. And if not on this show, definitely look forward to answering them over the next 2 weeks or on our next show. So without further ado, let's move on to a very fascinating interview with Dr. Jack Mintz. He's going to talk to us about big bang tax reform here in our country of Canada. Welcome, world-renowned fiscal and tax policy expert, Dr. Jack Mintz, to our show. Dr. Mintz is the President's Fellow of the School of Public Policy at the University of Calgary, a Senior Fellow at the C.D. Howe Institute, and Fellow at several other organizations. He has influenced the structure of provincial, federal, and international tax systems around the world. He has consulted with a number of organizations such as the World Bank, International Monetary Fund, and the Organization for Economic Cooperation and Development, OECD. Dr. Mintz became a member of the Order of Canada in 2015. Welcome to our show, Dr. Jack Mintz. Jack, thanks for joining us this afternoon.
It's my pleasure, Hal.
Excellent, excellent. I thought we'd start off by, asking or starting with a general question, getting, your feedback on, something we talk about obviously on the show quite a bit is the state of the Canadian economy. And wanted to ask you what your opinion is on the state of the Canadian economy, and do you think our current tax system is holding back its performance? We've seen latest numbers, GDP growing just over 1%. We're hearing a lot of questioning about efficiencies. Question or I have for you is, do you think the growth in our country is being held back by the current tax system?
Well, definitely yes, is the answer in short form. Even before the tariffs that Trump brought in this past year, Canadian economy has been doing very poorly since 2015. In fact, as many people, including myself, refer to it, it was a lost decade. And the reason for that is that we've had very little growth in per capita incomes in Canada from 2015, once you adjust for inflation. And as a result, we have actually had the worst performance of all G7 countries. And in fact, the OECD itself had projected that going on to 2030, even longer, that Canada was going to continue to slip relative to other countries. And there's many factors that explain it. I mean, there's not just one. Regulation is, for example, certainly a major one. But we have been slipping so much, especially relative to our neighbors to the south, that taxation certainly is one factor. You know, we've raised the top rate in Canada to 50, uh, roughly 52% across the country, 53.5% in Ontario. That is high, actually, by international standards. In fact, it's one of the highest in the G7 countries. And we apply it at a relatively low income level. In France and Japan, for example, the top rate is slightly higher, around 55, 56%. But in France, it applies at 14 times the average wage. In Japan, about 9 times the average wage. In Canada, it's about 3 times the average wage. So we collect a lot of personal income taxes in Canada, and they tend to be very harmful to the economy as a result. We did create a corporate tax advantage by 2012 relative to the United States and other countries as a result of tax reforms that went on from the start of this century. But now other countries have caught up and have even gone further ahead of us. And so now we no longer have a corporate tax advantage either in this country. So we have been losing investment. Our growth has been really poor, and certainly the taxation policy that we have followed over the past 10 years, or 11 years now, has not been a support to the Canadian economy.
Yeah, I once recently read an article saying that the biggest expenses that households have to face or pay is income tax versus their mortgage bills or any other bills and all, and that income tax adds up to more than all the other expenses put together. So definitely in agreement with you. You recently published an op-ed in the Financial Post saying that Canada needs big bang reform and reform that restructures how we tax people and businesses. Can you tell us a little bit about this big bang tax reform, what you mean by big bang? I'm assuming it's not the 1% decrease that we've heard the federal government talk about in the past.
Yeah, no, I think marginal changes aren't going to help very much. And some of the promises that politicians make often things like, I'm going to cut the gas tax, or I'm going to cut taxes on, a little bit on food, or I'm going to do something, some different types of taxes cuts. They're not going to really help the Canadian economy very much, not the kind of changes that we need. So I argue that we really need big bang reform, and that's because historically, Canadian incomes are been roughly around 90% of U.S. incomes. We've always been slightly lower than the U.S., but we generally trailed with them. But now that gap has increased to over 25%, and so we now have been slipping quite a bit, and a big factor has been the lack of investment that I've already mentioned. So I think we need big bang tax reform that really spurs the Canadian economy. In fact, I'd like to see the government get out of the way through tax reform, not trying to interfere with business decisions and personal decisions about how to improve our lives, but for governments to get out of the way. And we talk about the affordability agenda, but as you mentioned, taxes are actually the biggest part of a person's expenditure all the time. And no one ever mentions that. They keep talking about food and other things, but actually taxes are far more important as a share of people's income. And so, if we want to really create some affordability, I think we need to really address the tax system. And in case of Canada, we rely more heavily on personal income taxes as a share of GDP than any other G7 country, even the United States, that doesn't have a value-added tax like we do. And so we tend to over rely on the most harmful taxes in the economy, income taxes, well, where we tend to tax less than other countries is with respect to consumption taxes as well as payroll taxes. We tend to be lighter on those, and it's not that I want to say that we should just simply substitute one tax for the other. I would like to see tax reductions as well, but the worst part is also we have a poor tax structure that needs to be repaired, and I think Big Bang reform has got to be addressing that.
Yeah, I think I agree, and I read I've seen your videos and some of your interviews about the Big Bang tax reform, and I agree. I think to be more competitive, especially with our neighbors to the south, they're our biggest competitor now, especially when we're going into negotiations. That what they've done with their big beautiful bill or whatever you want to call it. These are things that are making them more competitive, allowing people to keep more money in their pockets at the end of the day. And I think it's a bit of a game changer as we go along here and continue to negotiate. Wanted to change gears a little bit. Something we hear a lot about in Canada and in certain states in the US actually is this idea of a wealth tax. And I wanted to get your take on it because a lot of my clients, my investors, those that invest with me, it's funny how the three letters TAX comes into the conversation always. Everyone's wanting to know how to save tax, how to save tax later on in life, how to live off of their RSPs and pay less tax. And then you hear this comment about do wealthier individuals pay their fair share? And a lot of people don't like that. This whole notion of everybody needs to pay their fair share. What do you think about those comments about the wealthy paying their fair share and this idea of a wealth tax?
Well, first of all, with respect to fair share, I guess we can all disagree what we mean by fair share. But uh, if I tell you, and this is the fact, that the top 10% taxpayers in Canada pay 55% of income taxes in Canada, I think we have to ask the question, are they really not paying their fair share already? And so that I think is very important to remember that right now, if anything, we tend to tax quite heavily higher income individuals. Um, and as a result, we sometimes see, and we're seeing more of this since 2015, people actually leaving Canada. Our data is not very good in terms of explaining why people leave Canada. We can't even test it very well, unlike other countries that are being able to do that, especially in Europe. But it's very easy if you want to give up Canada. You might have to pay tax your capital gains taxes on your property before you leave. But generally, you can go off and go to low tax countries, and there's been a lot of very significant taxpayers who have done that, and we've lost that tax base as a result. In the United States, it's actually easier to for the Americans to keep collecting taxes even when people leave the country because they tax people according to citizenship, not residency. So if you move to a low tax place, you may still have to pay American taxes, even if you live in, let's say, the Cayman Islands or something like that. But that's not true for a Canadian. They can move to the Cayman Islands, they can move to United States, they can move to all sorts of other countries, Switzerland, etc., and pay a lot less tax than you do in Canada. And we tax people according to their residency, not according to their citizenship. With respect to the wealth tax, again, this is used in very few countries today. There's only 4 countries that have wealth taxes. And often wealth taxes are used because people have trouble applying capital gains taxes. But in Canada, we have pretty healthy capital gains taxes on people holding property. And so when they sell it, they have to pay taxes on the gain that they get from selling their property. Of course, there are some important exemptions like principal residence. your house, your that you mainly live in, that may be exempt from capital gains taxes. But generally, people do pay capital gains taxes. Yes, at a lower rate compared to the general income tax, about half the rate, but still, people do pay that. And as a result, if you bring in a wealth tax, basically you're duplicating a capital gains tax.
I agree. And, statistics clearly show that, the wealthy do pay their fair share, as you've said. They pay the majority of the taxes the government takes in. So difficult to understand about this whole notion of paying your fair share. And I know a lot of investors are very upset by it. Thought I'd throw you a bit of a curveball, maybe something you don't get asked quite often. And I've asked this to a number of experts in the past. What do you think about a flat tax? What would be wrong with a flat tax? So, for example, everyone pays a 35% tax rate. I believe, if I'm not mistaken, we had that in Alberta for a short period of time. I know other countries, smaller countries around the world, have a flat tax. I have a lot of, again, investors, they'll say, just because they are more successful, they earn more income, why should they pay as a percentage a higher tax rate? If everyone just pays 35%, if a person makes more money, obviously in dollars, they will pay more. So what do you think about a flat tax? Could that be something that at some point down the road we ever consider?
I don't think it'll be considered in Canada because we do like to see some progressivity in our tax system. But flat tax was used in Alberta, and I think to significant benefit to Alberta because Alberta had a top rate of 39%, where everybody else was in the higher upper 40s at that time. And so, as a result, there were a lot of people that were shifting to United States to Alberta for that reason, and and Alberta was attracting a lot of skilled labor, which they need for their very significant industrial base there. So it was actually a very sensible policy from that perspective. The one thing about a flat tax is that it really isn't entirely a flat tax because everybody usually has an exemption level, which means that the first amount of your income is not taxed. It's a zero rate that applies there. So it's really a two rate system. It's one with zero and then a higher rate. So it's still progressive in the sense that people with higher incomes will pay uh, more taxes as a share of their income than people that, let's say, are just above the exemption level or below the exemption level will pay no income tax at all. So it's not entirely a bad tax, from the point of view of progressivity. It still achieves some of it. Of course, obviously, if you put higher marginal tax rates on higher income people, you have a more progressive tax system with higher tax rates at the top end. But of course, the choice of how progressive you want to make the tax system, of course, is a decision that is very much a political decision and what people would like to see as voters. Unfortunately, most people just want to lay taxes on the rich, thinking that they can cover all the public services that they want paid by the rich without them having to contribute to it, which itself is not a very good way of running, let's say, a government where people feel that they can offload the costs of taxation onto somebody else and for them to enjoy the benefits of public services, which is why some people like the flat tax because it's really a way of getting equal treatment of everybody, and everybody has to pay something to the government for the benefits that they get from government spending.
Along the same lines, do you ever hear pushback from individuals saying, paying 53% tax here in Ontario, the government is making more money or taking home more of our pay than the person is at the highest level? Do you ever hear that, this is something that should not, or people are complaining about enough that perhaps government, takes a look at down the road? Like, for the longest time, taxes, I understand if you want to make highest level just below 50%. But when you start crossing the 50% mark, now you're all of a sudden looking at individuals saying, hey, government's making more money than we are. How is this fair? Do you ever hear the pushback on that regard?
Oh, absolutely. In fact, I think it's quite egregious that, if you get a bonus or if you work a bit harder, that the government is going to take more than half of that money through the income tax. And I think that's really, I think, quite tragic, actually, in many ways. In fact, if you go back to the very famous Carter report that was written in Canada in the 1960s that led to very significant reform by 1972. They actually said that the top rate should never be above 50%. Because once you start hitting over 50%, as we now do in Canada, people resent that. And they start, the ones that are paying it, and then they start they'll do all sorts of ways to try to reduce their taxes legally. They'll avoid taxes, including deciding not to work. And so you end up getting really quite some negative results once you start hitting over 50%, because then people feel the tax system is being very unfair when the government's starting to take more than a half.
Yeah, no, for sure. And I guess my last question will end off, and that's what kind of all leads to it, and more of an opinion from yourself. Many people and organizations, have said recently, including yourself and me and many others, that we need, new tax reform to make Canada more competitive. I think a lot of us are saying that, especially, as I said, to make us more competitive in North America with our neighbors to the south. Why do you think our government, our federal government, is so reluctant to even talk about it at this stage? And talking to the Premier Ford, he wants more money in the hands of Ontarians. But I know that he's come in front of the press and has said that in the past. But I have not heard anything from Prime Minister Carney. So why is our federal government so reluctant to talk about it? And is there a reason for that? What's your opinion on that?
Well, there's two, I think, views of how to achieve growth in the economy. One view is that the government has to direct it and has to make the decisions about where to have money put by both the private sector and the public sector into certain activities, whether it's certain types of investments, major projects, et cetera, et cetera. The other view is getting governments out of the way, and of course, taxes are an obstruction to for people to improve themselves and to put effort into either their work or their savings decisions, take on risks, whatever. Taxes can dissuade people from doing that. And so, if you're the view, which I am, the government should get out of the way, then tax reform is very appealing. And of course, when Brian Mulroney got elected, his government actually undertook a significant reform back in 1984, first with corporate tax reform, then later with the personal tax and sales tax reform. Uh, and that was part of the whole objective of getting governments out of the way to improve, to get more economic growth in the economy. But that doesn't seem to be the way I think of our current government in Ottawa, where I think the view is that the government has to direct things. It's the one that has to make decisions. It's not the obstacle. It's the promoter of growth. And so now we have the major projects office. So we get certain projects that are going to get approved and they'll get subsidized by the government through industrial policy. And so it's the government that's being brilliant at picking the right investments and therefore encouraging the kind of growth that we want. That is a very different philosophy. And as you can tell, it's one that I don't buy in terms of the best way to achieve growth.
Well, it's we'll have to see how things go. Hopefully, someone in the federal government is looking at your big big bang reform, and maybe we'll hear from someone to implement some of those ideas, because I think they're great. Dr. Mintz is the President's Fellow of the School of Public Policy at the University of Calgary, Senior Fellow at the C.D. Howe Institute. Thank you so much for being on our show. It's been a pleasure having you, and I guess giving us all the information about tax reform and talking to us about taxes, something that I like to focus on our show from time to time. Thank you so much, Jack.
That's my pleasure.
Thank you. Just a great interview with Dr. Jack Mintz. Is no wonder that he's consulted with the World Bank, the OECD, International Monetary Fund. He's been involved in creating and structuring tax systems at all levels of government. It was a very enlightening interview, and Dr. Mintz is just so knowledgeable and some great ideas. And if anyone watching has not seen the video, there's videos out there about Big Bang tax reform and what he's proposing here in Canada. I definitely recommend you all go out and take a look at Dr. Mintz's videos and what he has to say. I found them quite fascinating. Now, the part of our show where we talk about three things that individual investors need to be focused on before they make their investment decisions. And as you can see, they're already up on our screen. Price of oil still affects the markets. Yes, the price of oil, as goes oil, still goes the markets. And as we know, that is price of oil and the markets, for the most part, are inversely related. One goes up, usually the other one goes down. Earnings season kicks into high gear. We're starting to get some of the biggest companies in North America and in the world start to report earnings. Kicks off with the big banks in the United States. We've already heard from most of them. Still have a few super regional banks to come, and then we'll start moving into some of the tech earnings. So we're going to talk about some of the companies and their earnings that they've reported. Keep looking at market valuations. For a little while there, in the month of March, when the markets were falling due to mainly what was going on in the Middle East, you saw valuations on some really good quality stocks fall. Since then, the month of April, the first 2 weeks, we're now mid-April, we've seen a lot of these companies rebound. Their stock prices rebound, and market valuations have started to go higher again. So I think you need to really start to, if not start to, but keep an eye on valuation. And I think that will really lead you to finding some good quality names that exist today. So let's move to our first topic. Price of oil still affects the markets. And that goes without saying, right? As we know, as goes oil for the last little while, goes the markets. Oil prices go up, markets go down. We've seen oil go up 5-10%. We've seen oil prices drop 5-10%. And with that, it takes the S&P 500 and really most markets on a bit of a ride. TSX, as we know, is made up of a lot of oil stocks, oil companies. So the TSX actually has benefited to a certain degree from the higher prices of oil throughout the month of March. And we've seen, whereas many of the other indices fell in value, I think at one point the S&P 500 was down 7%. The TSX really never fell. I think when the S&P was down 7, the TSX was up 3 or 4%. And again, that was on the back of higher oil prices. But make no mistake, right now, oil seems to be in a bit of a range, a lot lower than where it was in the low 90s when we came on air this afternoon. But I still believe that you need to keep one eye on the markets and the other eye on the price of oil. Our first chart shows exactly this: oil going higher and then coming down, and then the S&P coming down and then going higher. You can see the orange line is the S&P 500 and the blue line is the price of oil. And I can tell you today that WTI price for oil is around $93 a barrel. And the forward-looking contracts, so the contracts going out June, July, they expect the price of oil will fall into the 80s. And I guess they're banking on some sort of resolution to the conflict in the Middle East. Our next chart shows consumer sentiment, or consumer confidence, as we say at times. And with oil prices going higher, there is that fear that prices go higher in general. And what we get is an inflationary situation, perhaps even stagflation, slowing growth, higher prices. And that leads to the average consumer feeling a little bit more strapped, not able to afford certain things. Businesses having to pay more for fuel costs. Any business that transports goods, they're obviously feeling it. Jet fuel for airplanes and all that. So it's no wonder that the U.S. consumer sentiment recently was at all-time lows, even lower than when we saw it, I guess, about 5 years ago, 6 years ago now, when we had the pandemic. And you can see here, April, it was at a reading of 47.6. Be very interesting to see what the next reading is once we get the next reading, I guess, coming up at the end of April, early May. It'll tell us what the April consumer sentiment was. Obviously, the April reading will tell us how it was in March. Our next chart here has a few different things on it. Talks about the high price concerns for personal finances and the short run inflation expectations amid the Iran conflict. And really, for me, when you look at this chart, you want to look at both sides. So on the far right hand side, you see percent of consumers citing higher prices. So you can see on the right-hand side, the red line really starting to move higher. And you can see the red dot even higher than that. On the left-hand side of the chart, you see median year-end inflation expectations. They went extremely high when President Trump introduced the trade tariffs last year. Obviously, the expectation went up. Then as we moved on along the rest of the year, you saw the president starting to scale back some of those tariffs. And again, the expectation came down. And now you can see the dotted line on the far right-hand side starting to move higher again on the back of the expectation that higher oil prices will bring higher inflation once again. So as goes the market, or as goes oil goes, the market is a definite yes. And we still need to keep an eye on that, because even though we have a ceasefire in the Middle East, we're hearing from the president that they could get back to the negotiating table with Iran. We still have to keep track of oil prices, because if something should go wrong, and if the missiles start being fired again or in the air again, we could definitely see higher oil prices, which would definitely take down the S&P 500 and really most markets around the world. Our second topic, our second idea that obviously individual investors need to be focusing on is the idea of corporate earnings. And we are now in corporate earnings season. It's now kicking into high gear. We know that the big banks have already reported their, in the US, that is, their corporate earnings for the last quarter. And for the most part, I think they were very good. JP Morgan reported fantastic numbers, a beat on the top and bottom line. Citigroup, amazing, amazing. And their stock actually rallied when they reported earnings. Interesting enough, JP Morgan very rarely rallies on their earnings reports, even though they tend to be good. I know JP Morgan, that they they had some issues with some of their earnings, some of the parts of their business. Going forward, some of the forecasts on net interest margins weren't as good as thought. Goldman Sachs reported actually right before JP Morgan did, and they were blowout numbers: investment banking, equity trading, like all the other banks. Morgan Stanley reported really good numbers there as well. But Goldman Sachs had some issues with fixed income trading. So all the banks, they for the most part reported good earnings. Is it perfect? Obviously not. There'll be certain parts of their business that are a little soft. I know Morgan Stanley today, for example, reported blowout numbers, especially in wealth management. So that was good as well. Our first chart looks at the U.S. financials as a whole. The U.S. financials ETF, you can see that since the bottom in March, U.S. financials have really taken off once again. Our first chart, JP Morgan, you can see here, it's a year-to-date chart. You can see the lows in March and how things have really picked back up. JP Morgan stock actually got down to around $280 a share, down from a high of about $337 at one point. And now, as you can see, it's rebounded back above 310. Citigroup, I should say, they had fantastic earnings. The stock has continued to reflect great earnings. They too were down in the month of March, but have rebounded to all-time new highs. And interesting stat, Citigroup is now just getting back to their book value. So if you were to strip the bank and basically down to what it's worth, if you sold off all the real estate and what they have, right now they're just trading at a value that equals cost or book value. And many people believe that Citibank has a lot more room to run higher, because it should be trading at a premium to book value. So that's an interesting stat. All the other banks pretty much are trading at a premium to their book values, like JP Morgan, Bank of America, etc. Next chart, a little bit different. This is on Taiwan Semiconductor. Now, we heard from the big banks in the US. We're going to start to hear pretty soon. We're going to get some more regional banks, super regionals like a PNC, a US Bancorp. But we're also going to get into some tech reporting. Taiwan Semiconductor, for all of you that know the name, they are the biggest chip producer in the world. Now you're saying, well, I thought that was NVIDIA. Well, NVIDIA produces or creates the chips, and Taiwan Semi manufactures those chips. And NVIDIA is their biggest customer, along with other customers like Apple and AMD. And yes, domiciled in Taiwan, but Taiwan Semi has opened up a bunch of manufacturing plants in the United States. They continue to build out in the United States. A fantastic stock, a fantastic company at the forefront of the growth that we're seeing in the stock market. So we already know because they usually report monthly numbers on how they're doing. So we know this past month, Taiwan Semi was a great month for them. So I expect their quarterly earnings to be very, very good. Another stock that is going to be reporting, I believe, this Thursday, tomorrow, is Netflix. We have a chart on Netflix. Why do I bring up Netflix? Well, it's a name that was going really, really strong for a long time. Stock was trading well above $1,000 a share. They did a stock split, which is why the stock is where it is today. So it's not that it's fallen 90%, but the stock did fall because they were in this battle to buy Paramount. Paramount, yes, the famous Paramount with the movies and the TV. They were looking to buy it. When it was decided that they were not going to buy it, you can see what happened with the stock. Stock surged higher, and here we are today. Stock is moving even higher, $106 a share. Got down as low as in the 70s, and I think this stock has room to go higher even yet. So it's a name that I know a lot of people are interested in. Couple of names I wanted to end off with are a couple of software names. And this earnings season really is going to show us, it's going to be very important because some of these software names have been beaten up quite a bit for the fear of AI disruption. AI is going to revolutionize the way we look at software companies, basically do the job of many software companies, whether it's Salesforce, ServiceNow, which we have a chart on in a moment, Constellation Software here in Canada, Microsoft, which we have a chart, we can pull that up. And you can see these stocks have been getting hit because of that AI disruption and the fear that AI is going to eat their lunch, in other words, and take away business or take away pricing power from some of these software companies. So let's see what Microsoft is going to say. Are they going to be are they going to have great earnings? I think a lot of it's going to depend on their cloud business. Azure, it grew about 38% last quarter. Market was hoping for 40%, and that was the beginning of their stock falling. ServiceNow, our next stock, again, as I said, another software company, a SaaS company, as they call it, software as a service. ServiceNow, once upon a time, $200 stock, trading under $100. Today was up before we came on air. And again, we're going to have to hear what ServiceNow has to say. They're growing earnings at 20%, greater than 20% year over year. And that is something that I think the market will start to focus on at some point and bring up their stock price. So this earnings season is going to be really big for a number of companies, especially in the software space. Our third and final idea that individual investors need to be focusing on before you make your decisions is this idea of looking or keep looking for market valuations or looking at market valuations. Our first chart is on the S&P 500, and it quickly shows you that the S&P 500 year to date, the PE ratio of the S&P 500 has started to move up again. That tells you that valuation is starting to get a little bit higher. And you can see in the dark blue line there, that is kind of the top, and that is one standard deviation up or one standard deviation down from the average. You can see it there, and we're below that right now. So many people think that the S&P 500 has more room to run to the upside with respect to PEs. One of the main sectors living in Canada that individual investors like to focus on is the banking sector, right? We know banks seem to always go from the bottom left to the top right, that our banks, even though didn't really move a lot for a few years, there, last year was a great year for the banks, and many people have piled into bank stocks here in Canada, but I think they're starting to get pricey. Our next chart that we have shows the PE ratios from our banks. And you can see the banking sector as a whole, averaging about 14.5 right now as a PE. Usually I'd like to see, or from my experience, I usually have seen in the past 11 or 12. Now we're sitting at 14. Bank of Montreal and Scotiabank. Scotiabank's actually the lowest. Royal Bank and TD coming in at around 16 times earnings. historically on the high side. So does that mean you can keep buying these banks? Well, in my opinion, I think they're priced to perfection. And most of them, with the exception of Scotiabank, which is down maybe about 5% from its highs, they're all trading at all-time highs. We have a chart of the Royal Bank, our next chart showing a year-to-date chart. You can see it there. Wow, what a run it's had in the month of April. TD Bank, another chart that we have. Again, a huge run up in the month of April. We can flip over to TD Bank chart, and you're going to see there it is. And it's no surprise. It's almost the same chart, pretty much. If I didn't tell you that was TD, I could probably tell you that was Royal Bank, and you probably wouldn't have noticed the difference. CIBC Bank, our next chart, again, almost the exact same chart for the month of April. Looking at names like Enbridge. Enbridge is a name that a lot of people buy for the dividend. And I think, again, you got to keep your eye on market valuations. We have a chart of Enbridge as well. It is another chart that will show you how things are going year to date. It's a bit of a dip, I guess, coming out even in the month of April. I think it got as high as $76 a share. Dividend has fallen. Used to be, for those that bought it, dividend was well over 6%. Now it's just over 5%. Still a pretty good dividend. But again, you got to keep your eye on valuations. And I know, looking at my notes here, Enbridge is now trading at around 24 times forward earnings, something that I think is now a little bit pricey. CNQ, Canadian Natural Resources, another chart in the energy space. This one is oil producer. Its forward earnings right now, 16 times, not as much as Enbridge. CNQ dividend is definitely a lot lower than it was not that long ago. But again, if we do see a resolution to the conflict in the Middle East, oil prices will come down very quickly. We've already seen that. And that's also why you're seeing CNQ stock falling on the chart. Last but not least, Lam Research wanted to throw up a tech stock, a stock that has gone to the moon pretty much. Even when it pulled back, it was still highly valued. And it's a name. These guys, they produce or make equipment that makes chips or builds chips. And if I told you that they're trading at a multiple now of, let me see, there it is, 50 times forward earnings. So are we going to be looking at buying Lam Research at 50 times earnings? Probably not at this point, but maybe on a dip. So market valuations, it's something I think we need to keep an eye on. We need to keep an eye on the price of oil and what's going on in the Middle East, and earnings season. Earnings are going to keep coming at us. Today, we saw more bank earnings. Tomorrow, we're going to get some tech earnings. Next week, even more tech. And it's just going to be the earnings season is going to heat up. And this is what I think individual investors should be focusing on before you make your investment decisions. As we've seen already, markets have rebounded. Is this a surprise to any of you? Well, if it is, it shouldn't be. We know markets rebound after a crisis. Now, yes, crisis is nowhere near over, but I think what's happening is individual investors know the history. They know what happens when a crisis ends. They know how fast markets can rebound. And so when you get a dip like we saw in the month of March, they're very quick to buy that dip, and it's happening already. Now, I'm not here to say that we can't see the markets retest the lows of March or even pull back to some degree. Sure, it could happen, and a lot will depend on, yes, the conflict in the Middle East and the price of oil and what's going on in the global markets around, obviously around the world. However, I think, and many think, that maybe the worst is over. Maybe they do come to some resolution. That is with Iran, United States. Perhaps they enter into further negotiations, further talks. We're hearing that that is a possibility as soon as next week. So market, I think, is, as it does, gets ahead of itself, and it is the best forward-looking indicator that we have out there. Our chart shows clearly what has happened. Stock market swings chart. There you have it. And you can see the day the ceasefire was reached, look at that chart, almost in a vertical line. That stock market went higher. Markets are up. They're actually up on the year now, once again, just under its all-time highs. Our next chart we've seen many times. This is the impact of geopolitical events on the markets. This is from McKinsey Financial. And you could see all the different times we had different crises and what happened to the markets. And you could see in the middle there how long it took for the markets to grow, how many months it took for the markets to recover. And the Korean War took what, 2 months, which was unbelievable. Cuban Missile Crisis, 10 months. And look at the 1 year later numbers. Fantastic. 31%, 43%, 37%. 2 years later, 59%. So I think investors know this. They know this is going to happen based on what we've seen in the past. They know markets go up. That's what they do. In 1980, the Dow Jones was 1,000. Today, well, most recently it reached close to 50,000. So we're getting there. And I believe that the markets will rebound. I think all of you watching know that this will happen. It's more a matter of when, not if. And so in the meantime, individual investors have already started to buy this market. And for those that unfortunately got out of the market, which hopefully aren't many of you, hopefully you get back in soon, because I think that when we do get a deal between Iran, United States, and Israel, I think this market has even further to run higher. So never try and time markets. Stay in these markets. Maybe do a little bit of maintenance on your portfolios, but definitely stay in these markets, because it is proven that over time, markets go higher. Take futures markets with a grain of salt. Now, I bring this to you all today because some of you look at the markets when you wake up in the morning before you go to the office or go to work, and you see, oh, futures are showing that the US markets are going to be down today or up today. And a lot of people take that for gospel, that, oh, markets are going to be up, and that's it, and nothing else left to say. And that's not true. To me, futures markets are the markets that you see prior to the market opening. Number one, in my opinion, a lot of it's being controlled by computers, computer trading. We'll touch on that in a moment. But I believe it's not the average investor. It's not the average investment advisor like myself that are buying, because we don't have access to the markets prior to the market opening at 9:30 here, Eastern Standard Time in Toronto. What it is, in my opinion, is what has been reflected overnight while we're all sleeping in Asia and in Europe. And obviously, if those areas of the world are negative, then the futures will probably show negative. If those parts of the world are positive, then I believe our futures markets, or the US futures markets, will show positive. The best example I can give you, our first chart, we can pull it up, is the futures markets of today. So you take a look at this, you would say, oh, the Nasdaq's going to be down today. S&P will be up slightly, and the Dow Jones will be up a lot. Well, I can tell you, when I came on air, the Nasdaq was up 200 points, the Dow was down 200 points, and the S&P was up, I wouldn't say a little bit, but it was up a little more than what you're seeing there. So there's no way to know what these markets are going to do on any given day. The trading day is very long. It's a number of hours. So the futures just reports, or just tells us, in my opinion, how things looked coming into trading in North America. And as I said, a lot of this futures trading, a lot of trading during the course of the day is done by computers, algorithms, programs. And we've talked about this before. What are they picking up on overnight or during the course of the day? Headlines. Our next chart or illustration shows all the headlines that came out on April the 12th, Sunday, April 12th, just a few days ago. And futures were all showing red. Guess what? The markets on Monday went higher. It turned around midday and went higher. Look at some of these headlines. Trump orders Iran blockade, oil back above 100. Iranians left disappointed but defiant after failure of peace talks. All of this was negative. The futures were all red. And in the end, what did it show us? Nothing, because the markets were higher. We have our next chart showing algorithmic trading. We've shown this chart before. It's a little bit complicated, but at the end of the day, these algorithms, these computers, they are designed to pick up on data, as it shows there, market data, historical trades, but it also news and sentiment. That is that's the headlines that we just showed you. That's how these computer programs are designed, And that's what they do. They pick up a negative headline, boom, a cascade of sells then happens. If they pick up a positive headline, then obviously buys happen. Pros and cons of algorithmic trading. Our next chart, you can see some of them here. Some of the pros: eliminates human elements and emotion. Definitely a lot of emotion lately. Some of the cons: doesn't work without electricity or the internet, obviously. Can look good on paper, but underperform. Over optimization is possible, requires lots and lots of data, compute power, and expertise. So pros and cons with algorithmic trading. And again, when you wake up in the morning and you see these futures markets, don't get too worried about it. I've seen things turn around. We just saw things turn around today, even in the market. So understand that you're not seeing the actual markets trade necessarily, as you are looking at sentiment, negative sentiment overnight or positive sentiment overnight. And that's how you should think looking at these futures markets. Mixed economic signals. We definitely have seen a lot of them. And I think that has led the central banks, Bank of Canada, Federal Reserve in the US, really to kind of just sit on their hands and really do nothing, right? We're getting higher inflation in the US. We're starting to hear about higher inflation here in Canada once again, even though numbers have been pretty tame so far. We're seeing jobs growth at times, job loss at times. Very, very confusing. And it's no wonder that the Bank of Canada tells us that they really can't do much more at this point. They're waiting for the federal government to start to do things to hopefully grow jobs and grow the economy and get GDP higher again, at least higher than the 1.5% that it's at right now. Our first chart shows Canadian employment change, and it just shows you how confusing it is right now. Look at these bar charts. You're going to see the last bunch of months, we had 2 negative months, July and August, followed by 4 positive months of job growth, followed by 2 negative months of job growth, and then most recently, a slightly positive month again. I know that the central banks, they don't really look at individual months as much as they look at it in quarters. So they'll take a 3-month period at a time. So if you look at the last 3 months, you'd see that the job growth has been negative. 4 months or 3-4 months before that, positive. 3 months before that, negative. So there's the up and down that we seem to get. U.S. jobs growth by month. Our next chart, you don't have to take it in 3-month increments. You can take it in 1-month increments, up and down and up and down and up and down. If this pattern holds true, I guess we're going to have negative job growth for the month of April. But it just goes to show you how it's just all mixed up. Some of it has to do with what's going on in the world, the uncertainty. Companies don't want to hire if they don't know about what's going to happen and if the consumer is going to have more money in their pockets to be able to spend. A lot of it has to do with artificial intelligence. Is AI the disruptive force? Is AI taking away jobs? I think the answer is yes. Perhaps lower level jobs, but taking away jobs nonetheless. We have our next chart about inflation, PCE, and you can see in the States, PCE around 3%. That was, last number was a February number. Very interesting to see what a March number will look like. Consumer Price Index, CPI, our next chart is a March number, and you can see that it has ticked up. There you have it, 3.3%. That is the headline number. Core CPI hasn't really moved yet, still at 2.6% where it was last month, whereas last month the headline number on CPI was around 2.5 as well. Now it's all the way up to 3.3%. So we are starting to see inflation seep into the US, still not into the core numbers, although as Austin Goolsbee says, which we'll see in a moment, if oil prices remain high, we're going to see more and more the inflation seep into the core numbers or core inflation numbers and seep into the economy more. So overall, mixed jobs reports, inflation on the rise. Yeah, it's no wonder. I think the Fed will probably be on hold for the foreseeable future in the US, and no wonder that the Bank of Canada has told us the same thing. Quick hits. Three things that I've noticed in the news that I wanted to make a comment on that I think many of you have noticed as well. First one may not be noticed by many, but we noticed it. Canadian dollars being dumped from fixed reserves at record pace. What's going on? We're noticing that for a while, individual investors were buying the Canadian dollar, and we've seen a decline in the Canadian dollar and people selling it. What's going on? Oracle pops nearly 13%, leading a bounce back rally in software stocks. Yes, we've seen software stocks, the stocks that have been beaten up probably the most. One of the most beaten up sectors of technology and in general over the last year or so. We're noticing a bit of a reprieve and these stocks rising. Chicago Fed, Austin Goolsbee, the longer the war, the more a rate cut gets pushed off. I think that is obvious. So let's go to our first one, the Canadian dollar being dumped or sold off. Our first chart shows the reserves managers let go of Canadian assets in 2025. Could that be because of the trade war between the US and Canada? Quite possibly. We know that when oil is in favor, when commodities are in favor, people tend to buy the Canadian dollar because that makes up a very large, commodities in general makes up a very large part of the Canadian economy. So what do? Well, you buy Canadian dollars. Last year, it was all about tech. And obviously, we do have tech here in our country, very successful technology, but not as big as the US. And so I think that led perhaps also to investors selling the dollar over the last little while. But make no mistake about it, perhaps we get buying coming back in once again now that oil prices are higher, and that maybe, just maybe, a lot of countries will start using Canada as Ian Lee said a couple of shows ago, as their supplier of natural gas and oil. Our next quick hit is about Oracle. We have a chart on Oracle, and you can see the rebound in this chart. And look at Oracle stock on the far right-hand side. Oracle, once well over $300 a share, got down as low as $130, $126, and now has rebounded back to $163. This again is on this sell-off was because of spend at Oracle. They were spending a lot of money, and the market was struggling. Investors were struggling to see if all this spend was going to produce returns. And the second part was Oracle is considered software. Our next chart shows software stocks, how they've been beaten up, and how the two-day rally, which is the green, has shown a bit of a bounce back. Look at the red. Look how much Salesforce, Palantir, Oracle, Microsoft, iShares software ETF in general. Look how much it's been beaten up. Again, is this a buy the dip scenario? Quite possibly. And maybe we're just starting to see the buy the dip. We've seen ServiceNow move higher. We've now seen Microsoft. We've seen cybersecurity stocks move higher. So maybe it's the buy the dip mentality. I, for one, hope that is the case. Our last quick hit that I wanted to touch on is this quote from Chicago Fed Goolsbee. The longer the war goes, the further a pushback in rate cuts will be. Our one chart for this is the target range for the federal funds rate. We can show it there. Yes, you'll see on the right-hand side a bit of a flat line. Many believe that this chart will continue to flatline for the foreseeable future, although it is expected once we can get past this conflict in the Middle East and once we can see oil prices come down and we can see inflation come down with it, that perhaps, just perhaps, by the last quarter of this year, we get maybe as many as one or two rate cuts in the United States. But as long as Austin Goolsbee says, as long as this war goes, price of oil remains elevated, inflation remains elevated, and so they will continue to push off an interest rate cut. So these are just three ideas, three things that I wanted to comment on for all of you. Some of these things, as I said, you probably have seen in the news yourselves and how the markets are being affected. What's my take? Part of the show where I take at least one of your questions from the audience. This is a question I've received over the past couple of weeks, and we have time to squeeze it in. It says, for investors who have limited cash flow, who don't have a lot of money to invest, do you recommend they prioritize their TFSAs or RRSPs? Said on the show many times, the difference between the two is very simple. If you need a tax deduction to reduce income tax, RSP is where you want to be. If you don't need that tax deduction, then TFSA is definitely a great choice for your investment dollars, especially, well, obviously, if you have the room. We know that there are limitations on both RSPs as to what you can contribute every year, and that goes as well with respect to TFSAs. If you don't contribute to a TFSA or an RSP, that room that you have gets carried forward indefinitely. So if you don't use it, you don't lose it for either account. But the differentiating factor is that tax deduction. So with that, I want to say thank you to all of you who have tuned into the show for this week. As always, I hope some of you have taken away something from our show, some piece of information, or maybe it was what Dr. Jack Mintz had to say about tax reform. And I definitely encourage everybody to pull up his videos and hear what he has to say. I found it very informative. I want to wish all of you a great success over the next couple of weeks. We will be back 2 weeks from today, Wednesday, April the 29th, at the same time across all social media platforms as always. And until then, happy investing.